What does below target actually mean here?
So they raised $2.2 billion for their latest venture fund. Keep in mind, it's a very difficult fundraising environment, and this fund has been very slow to attract capital. But what's interesting is that this really is a sharp pivot from the funds that we've seen Tiger Global raise over the years. Their last one was nearly $13 billion big. Each subsequent fund over the past few years has been bigger and bigger than the one before. So this is a very small raise compared to what they're known for.
So I'm curious, is this something that's specific to Tiger Global, or are we going to see some of their other peers also see some of the same issues in trying to raise this kind of money?
Yes, it's a very, very challenging fundraising environment for venture. So you've seen some firms already miss their targets. It's not uncommon in this environment to struggle to raise money for an asset class that has seen steep markdowns, that has seen a lot of trouble with investors having money to invest. Private equity has been slow to give distributions, and so that's limiting the amount of money that some of these allocators have to invest as well too.
So what does it wind up meaning then for Tiger?
Right. So Tiger Global, this has been a firm that's been very fast and furious when it comes to investing in venture. For years, they were putting hundreds of millions of dollars, billions of dollars to work, investing in hundreds of startups a year. They were one of the most frequent investors. Now what we're seeing is something of a pivot, where this is a very small fund in a challenging environment, as the firm has seen a lot of steep markdowns themselves. And so they may take a little longer to put the money to work. Already, you've seen a slowdown in the pace of investments from firms like Tiger Global. It's just been trickier.
Yeah, so I mean, is the bloom off the rose for all these folks? I mean, I know we talk about Tiger Global and all the other sort of disciples of Julian Robertson and that, and I know they've all had kind of varying degrees of success and hiccups here, but Tiger Global, I mean, I feel like I've been talking to you about their troubles now for like 2 or 3 years.
Yes,
yeah.
So it's been a rough year for them. It's been a rough year for many of their peers. They in particular felt pain on both the hedge fund side and on the private side. And you're seeing, when it comes to these crossover funds, a lot more, I think, skepticism and cautiousness in how people look at these funds, because they're like, okay, well, you have private assets in a public vehicle. Sometimes they're commingled together, sometimes they're not. In Tiger's fund, Tiger's case, they've got the venture fund separate from the hedge funds, but you do see some firms where they are smushed together, essentially. So there are a number of challenges that come up with that, and I think hedge funds going into venture has been a thing that's been really sort of capitalizing on excitement and interest for years, and I think there's some cautiousness to that now.
So this would be a very silly question, but you know, tech and AI is all the rage in the public markets. You would think that betting on smaller AI plays or startups or tech beginners kind of thing would be a good thing and provide a lot of opportunity. Why is that not the case right now?
Yes, so it has been for years. The big tech bubble, a lot of these companies did really well. But as we've seen interest rates rise, you've seen startups really struggle with their capital, with their managing of costs, with paying off debt. And not every company is a winner, right? So a lot of these firms, they invest in so many companies, so many startups, to sort of like, you just need a few of them to win in order to really make money. But as the pain really hit a lot of them at the same time, and you're seeing the struggles really across a lot of them at the same time too, and so that's impacting a lot of the funds.